Welcome all. I am Karthick Manikandan from CSE. This is assignment 2 for project management finance. Today we are going to see about project management finance. What is a project? High operating margins, low to medium return on capital, limited life, significant free cash flows, few diversification opportunities, asset specificity. What is a project? Project have unique risks, symmetric risks, asymmetric downside risks, binary risks. What does a project need? Customized capital structure, asset specific governance system to minimize cash flow volatility and maximize firm value. What is project finance? Project finance involves a corporate sponsor investing in and owning a single purpose industrial asset through a legally independent entity financed with non recourse department. Project finance, an overview. These are the examples for outstanding statistics and some major deals. These are the examples for total project finance investments and the number of project example graph and lending by type of department, project finance lending by sectors. The project structure elements or structure highlights comparison with other financing vehicles, disadvantages, motivations, alternative approach to risk mitigation. Structure highlights independent single purpose company formed to build and operate the project and the extensive contracting as many as 15 parties in up to 1000 contracts. Contracts govern inputs of tech, construction and operation. Government contracts, concessions, one-off or operate transfer. Ancillary contracts include financial hedges, insurance for force majeure, etc. Structure highlights highly concentrated equity and department ownerships, extremely high department levels. Comparisons with other vehicles. These are the major comparisons of financial vehicles, similarities and the dissimilarities. Disadvantages of project finance often takes longer to structure than equivalent size corporate finance. Higher transaction cost due to creation of a independent entity can up to 60. The project department is sustainably more expensive, 500 to 400 basic points due to its non-recourse nature. Extensive contracting restricts managerial decision making. Project finance requires greater disclosure of proprietary information and strategic deals. Motivations, agency costs. These are the some examples, problems and structural solutions for motivation agencies. And these are the example problems and structural solutions, agency costs, motivations. Why corporate finance cannot determine opportunistic behavior. Do not allow joint ownership. Direction expropriation can occur without triggering default. Creeping exploitation is difficult to detect and highlight. Multilateral lenders which help mitigate sovereign risk lend only to project companies. Non-recourse department had tougher convenes than corporate department and therefore enforces greater discipline. In the absence of corporate safety net, the incentive to generate free cash is higher. Alternate approach to risk mitigation: risk, completion risk, price risk, resource risk, operating risk, environmental risk, technology risk. Solutions: contractual guarantees from manufacturer, selecting vendors of repute, hedging, keeping adequate cushion in assessment, making provisions, insurance and the insurance, expert evaluation and retention accounts. Alternate approach to risk mitigation: political and sovereign risk, externalizing the project company by forming it abroad or using external law or jurisdiction, external accounts for proceeds, political risk insurance, export credit guarantees, contractual sharing of political risks between lenders and external project sponsors, government or regulatory undertaking to cover policies on taxes, royalties, prices, monopolies, etc. External guarantees or quasi guarantees, interest rate risk, swaps and hedging, insolvency risk, credit strength of sponsor, competence of management to good corporate governance, currency risk, hedging, financing choice, portfolio theory, options theory, equity and department, type of department and sequences. Thank you.